All right, let's just jump right into this explainer. Have you ever looked at a stock price flashing on your screen and wondered what it actually means? You know, the price updating down to the absolute paisa. But here's the thing. What you're seeing isn't necessarily what that stock is actually worth. And let me tell you, those two numbers, they drift apart all the time. Honestly, the entire game of investing lives right in that gap.
Think about it like this. Two people can look at the exact same stock price, updating at the exact same second, and completely, absolutely disagree. One person is frantically hitting buy, seeing a screaming bargain, while the seller on the other side thinks, wow, this is a complete ripoff. How on earth is that possible? Well, it's because price and worth are not the same thing. And honestly, learning to tell them apart is where your investing journey really begins. So let's get into section 1, price versus value. You know, Warren Buffett often quotes his mentor Ben Graham using a phrase that literally defines this entire concept. He says, price is what you pay, value is what you get. It's just 8 words, but it is so profound. The price, that's just the sticker on the item today. But the value is what the business is genuinely worth to an actual owner. Sometimes the sticker matches the worth, sure, but very often it completely misses the mark. Listen, a company doesn't magically become twice as valuable in 6 months just because its stock doubled. It just doesn't. Price is set by people, wherever a buyer and a seller happen to agree on any given morning. And let's be honest, people are moody, right? We get incredibly greedy when everyone's making money, and we panic when the headlines turn grim. That is exactly why prices swing so wildly. Value, though? Value is set by the business itself. It moves slowly. The underlying value of a business might only move a little bit over those 6 months. But the price can swing all over the place.
Which brings us to section 2, slices of a real business.
We really need to stop looking at stocks as just lottery tickets or numbers in an app. When you buy a share, you are buying a small slice of a real, breathing company. You literally own a fraction of their physical factories, a share of their real customers paying for services, actual cash sitting in their bank accounts, and reliable profits landing every single quarter. A share gets its worth from all the future cash the business can throw off over its lifetime. That's why a company that reliably earns, say, 100 rupees a year for decades is vastly superior to some one-hit wonder that makes 100 rupees once and just fizzles out.
So remember this. Value is entirely about that future cash. It is absolutely not about the mood of the market this morning. As an investor, your job isn't to predict daily mood swings. That's impossible. Your job is just to maintain a rough, sensible gauge of this underlying value. That way, you can immediately spot when the price has wandered entirely too far away from reality.
All right, moving on to section 3, the PE yardstick.
So, what's the simplest tool we have to gauge if a stock's price is straying from its value? It's the price-to-earnings ratio, or PE. You just take the price of one share and divide it by the profit that company earns per share in a single year. Now, to be fair, this is a blunt instrument. It's a starting point, not the final verdict on a company's destiny. But it perfectly answers that one core question: what am I actually getting for my money?
Let's just break the math down for a second. Say a share costs 200 rupees and it earns 10 rupees a year in profit. Your PE is 20. Think of it like this. You are paying 20 rupees out of pocket today for every 1 rupee of annual profit the company generates. A high PE means the market expects really strong growth ahead, so investors are happily paying a premium for it. A low PE, on the other hand, signals modest expectations, or maybe just nervous investors.
To put that into some real-world context, back in late July 2026, India's Nifty 50 index traded at a PE of roughly 20.7. That was just a touch below its 10-year average. So what does that actually tell us? Well, it means the broad market was priced fairly. The mood wasn't euphoric, it wasn't panicked, it was just a reasonable, middle-of-the-road baseline.
Let's ground this in reality with section 4, the tea shop analogy.
Picture a small, bustling tea shop right near a busy train station. It clears a steady 5 lakh rupees in profit every single year, reliable as clockwork. Now imagine you could buy the whole operation for 25 lakh rupees. You're paying 5 times its yearly profit, right? So a PE of 5, that feels pretty reasonable. You'd earn your purchase price back in profits in just 5 years. But wait, what if the exact same shop, same tea, same customers, same 5 lakh profit was selling for 1 crore? That is a PE of 20. It would take 20 years of profits to earn your money back. See how the drastically different price tags completely change how good of a deal you're getting, even though the business itself hasn't changed at all?
So which price is right? Well, it entirely depends on what happens next. If a brand new metro station is opening right next door and profits are about to skyrocket, paying 1 crore with a PE of 20 might actually turn out to be incredibly cheap. But if the neighborhood is emptying out and foot traffic is dying, even paying 25 lakh for a PE of 5 could be a terrible mistake. Value always leans on the future. That's why it's never just one perfect number you can punch into a calculator. It's more of a sensible range based on honest assumptions about what's coming next.
Okay, moving to our final part, Section 5, Surviving Market Moods.
When you finally separate price from value in your head, a massive shift happens. The market completely stops feeling like a crazy, unpredictable casino. Instead, it starts to feel like a giant shop filled with really badly written price tags. You start to realize that some items are marked way above their actual worth. But a few are quietly marked below. And here is the absolute best part. You don't have to buy anything today. You have the ultimate freedom to just walk out of the shop and wait for a better tag. It's a superpower that even professional traders often forget they have.
Keeping this difference between price and value constantly in your mind, it literally protects you from the two most expensive emotions in investing, FOMO and fear. When a stock is soaring and everyone's piling in, remembering that even a great company is a terrible buy at the wrong price, that stops you from overpaying. And when markets crash and prices collapse, remembering that a business hasn't lost its intrinsic value just because its screen price fell, that keeps you from panic selling perfectly healthy businesses.
So, the crucial takeaway to remember from this explainer is that price and worth are completely different beasts. A share's real value comes from its future profits, not from how the price wiggled around this week. And that PE ratio? It's your essential quick start gauge to figure out if you're looking at a bargain or a complete ripoff.
Now I'm throwing it over to you. Pick a company you interact with every day, maybe your bank or the maker of your favorite biscuit. Pull up their PE ratio on an app. Are investors paying 15 rupees for every rupee of profit, or are they paying 60? Before you ever ask, is this going up? Force yourself to ask, is this actually worth it? Stick around, because in our next explainer, we'll dive into exactly how this very same PE metric is used to fool millions of investors every single day. See you then.